Welcome back. In this video, we're going to take the final steps about decision measures. We're going to start with net present value. We're going to use information that we have calculated previously, also available in previous videos on how we did that. We did pro forma income statements, capital requirements, operating cash flow, total cash flows to include present value and future value. So net present value, we already did the bulk of the work. We already did the bulk of the work down here. So all we got left is to offset the present value of the cash flows that we calculated previously by the initial money that went out on year 0. So in this case, once you have the present value of the cash flows, you added to whatever the cash flows were for year 0. And that gives us a net present value of $10,648.32. This is a positive NPV. On the decision rules, positive NPVs add value. If you were just deciding on one project, if you should take it or not, then yes, you should take this project. It adds value to the company. If you're comparing projects and you can only choose one, then you'll have to compare the net present value and choose the one with the highest present value. If you have a series of projects and you can choose more than one project, then you put them in order of net present value and you start working your way down the list until you can't afford any more new projects. Internal rate of return. This is a function in Excel. And in your financial calculator, you can do it too. There is no direct formula to calculate this. So what we do is we're going to use the IRR function, and in your calculator, you input the cash flows to get that. So the internal rate of return of the cash flows at hand are these right here. The total project cash flows. Those are the ones we want to calculate. So we have an internal rate of return of 25.76%. The way you use this is you compare it against your required return. And if you are getting more return percentage-wise than the 20% required return you have here, then yes, you accept the project. You're getting more than what you are required to get for this type of project. Typically, when NPV is positive, this will be also higher than the required return. Now, there are situations where the IRR and the NPV do not coincide in the decision, then NPV is the one you follow. If, for example, the NPV here was 10,000 positive, but this was like 18%, which is lower than the 20% of the required return, then you ignore the IRR and you go with the NPV. The NPV trumps the decision. Now, the modified internal rate of return. Now, I'm going to copy and paste a formula I already have, and then I'll talk through the formula. It's a little easier to visualize that way. So the modified internal rate of return, we're going to start with H35. Let's look at H35. So we're going to start with this number here. The future value that we calculated in one of the previous videos from these cash flows. The sum of the future value of the cash flows that we have here, it's our starting point on this formula. We're going to divide that by the absolute value. That's what that ABS means. The absolute value of the total project cash flow here. Now I have absolute value because we need that number to be positive. So regardless of it being negative or positive, it needs to be positive for this formula to work. So we started with the sum of future value divided by this number, the absolute value of that number. That number is going to be raised to an exponent. That exponent is going to be 1 divided by the years that we need to move this. This is kind of a present value calculation as well, because we're going into the 0 year. So this has somewhat of a discount effect. So for 3 years in this case, 1 divided by the N2 for that 3 years there, the end of where we are. Because remember, this future value is the future value project on year 3. And then after you do all that, all you do is a -1. And that's what we end up with 23.75%, which is higher than 20%, which means accept the project for the same reasons that we did IRR. Now, the reason for the modified internal rate of return is, as I mentioned, IRR is not a direct formula for it. It's a trial and error process. This one is something you can actually calculate. And as you notice, it's a little more conservative or more strict, as it gave us a lower number. Okay, profitability index. This one is related to NPV. Okay. And you use the same numbers of NPV, but instead of adding and subtracting, you are going to do a division. So we're going to be using this one and this one like we did with NPV. Now, in PV, we added them. Here, we're going to divide them, and we're going to do the absolute value approach as well. So if we take the present value of the future cash flows and divide it by the absolute value of this one, number that we want. Let's take a look at that. That's the answer. Let's look at the formula. We took the present value divided by the absolute value of this one. Once again, because we need it to be positive for it to make sense. And the number is 1.097. Technically speaking, anything above 1, you accept the project. Anything below 1, you reject the project. If it's 1, that's the same as saying NPV 0. And that's where people are on the fence. Some argue that NPV zeros or profitability index of 1, you should reject. Others say you should accept. But that's that indifference point. However, here it's above 1. And like I said, since we use the same numbers NPV as closely related, that just gives us different pieces of information. This one tells us that it adds value. This is tell us how much value does it add. Payback period. Okay, so this one works. I'm going to put a formula here, but I'll explain why the formula looks a little more complex than where it needs to be, but that's because I have it set up in a way that the numbers can be adjusted and Excel itself decides when to stop. Because in payback period, you move to the next step and take a look and decide if you stop there or if you move to the next step. So let me tell you what this formula is doing. It looks, I have if statements in there. You see if and if again, and this is why. The payback period really, let me go ahead and do this so we can see the cash flows. We are using these cash flows. All right. We are using these cash flows here, but this is what's going on. What it's telling us is it takes 2.09 years to get your initial investment back. That 110,000 that you put out in year 0, we want to know how long does it take to get it back. So I'm going to modify this a little bit so you can see it in action. So we put $110,000 out. So that's how much cash is out. On the first year, we get 51,780 of that cash back. So we start getting paid back. That's what's called payback period. So what we do is, I'm going to put this number is what we started with, plus what we got back. plus that one we got in. So from the 110, we recovered 51,000 and change. So we still need to recover another 58,219 in order to get our 110 back. So we're not there yet. We have not been paid back yet. So we got to move on to the next year. So now you take what's left to get paid back plus what came in. Now you're down to 6,439 that you have not received back yet. So you got some cash back, you got some more cash back, but you haven't gotten the 110 yet. You still need to recover another 6,000. Now you look at the next year, and that's when you say, okay, this is where it's going to stop, but where? When does it stop? Because next year is going to bring in 71,000, but you only need to recover 6,000. That's what we want to know. Now you have to assume that 71,000 comes in an even pace. Like there's no ups and downs. It's all, same amounts day to day, month to month, etc. So the point is, once you see that the next year is going to bring in more than what you have left to recover, in other words, this number is greater than this one, the absolute value of that one. Same thing happened here, for example, 58,000, the absolute value is greater than this one. So you got to keep on going. You're not going to have it all back yet. But here, you will get it all back, but it doesn't take you the entire year. So one way to look at it is, we're going to go ahead and take the absolute value of this one here, and we're going to divide it by what's going to come in next year, and you get that 0.09. Let's put that this way. So what happens is it took 1 year, 2 years, and 0.09 of the third year, not the entire year. So 2 plus 2 years plus this, 2 years plus that decimal, and that's how we got the 2.09. But this is a step-by-step decision. This could have taken longer or shorter. All you're doing is, okay, money went out, this much comes in, this is what I got left over to recover. I look at the next year. If the next year is not enough to recover this, you do the exact same step again, and you keep on moving forward, because it's going to take an entire year plus some more. But once you see that the next year is going to bring you more than what you still have to recover, that's when you do that division, and you get the 0.09. And then you add them every year that it took, in this case, 2 years plus the 0.09. And that's how you do the payback period. The way I wrote it in Excel is just so it does that automatically. It looks at the next year and keeps on moving. And if it's not, then it does the division. And that's what those if statements there, but that's all it's doing automatically. However, when you do it, you can do it step by step like this. Discounted payback period is the exact same thing as a payback period, but is using discounted cash flows. So instead of using these cash flows, we got to use the discounted cash flows, which are the ones we calculated below. So let's go ahead and take this out. We already calculated, and put a little space here so we can work with the discounted cash flows. I'll repeat the process, but it's the same thing. We start with the amount of cash that went out, but we're going to consider that cash flow instead of the higher one, because yes, I'm going to get 51,780 next year, but that's nominal. The real value is 43,000 in today dollars, because the $110 that I put out was on today's dollars. So we do that, and we get, and we get that 66,000 to go. Once again, I compare this to the next cash flow. That's not going to cover everything here. So we repeat the process. So we're down here. Now this one will cover that amount. So at this point, I can go ahead and do my division of the absolute value, just so I can get a positive number of this number divided by the amount of cash flow. and I will get 0.74 years. So it's 2 years plus 0.74 the third year to recover my money on discounted cash flow approach. And if I was to do this with a formula, as I mentioned before, where Excel does it automatically, we can do with the ifs. That's all it's doing, is doing the same thing I did a moment ago, but it's just checking on the next one before it calculates. And there, so you see the 2.74, which reflects the 2 years and the 7/4 year. Now, last one that we're going to do is average accounting return. By the way, these payback periods, the way you make the decision will have to be based on a rule the company has. If they have a rule saying payback period has to be 3 years, then you could accept these projects because you get it in less than 3 years. If they had a rule of payback period is 2 years, then you would reject this one because it takes longer than 2 years. Now, average accounting return, AAR. This one here is actually a lot simpler. And all we're going to do is we are going to take, allow me 1 second. We're going to take that average assets that we calculated earlier, and we're going to divide it by the net income in this case. 1 second, something didn't go right here. Oh, I clicked on the wrong thing. Allow me 1 second. This is definitely not it. Okay, equal to, it looks like I did it in reverse. Where are my average assets? Equal to the net income, I had it flipped. Divided the average net income. Average net income divided by the average assets that we already calculated previously. And that's 33.51%. Now, just so you know, the average net income in this case would be the same number because the net income didn't change every year. So you could just grab one of them. However, if these were different, yes, you must follow that step of the average net income. So we have the average net income divided by the average assets. Once again, this one here, you could have a number the company dictates. We need our average accounting return to be higher than blank. Or for lack of more information, you can use the required return. It's not a direct comparison, but it helps if you have everything else. But the point is that it has to be compared to something, and then you decide if it's higher than whatever that number is, then you accept the project. Okay, and those were decision measures. That will be it for this video.